Mortgage demand plunging last week to levels not seen in more than 20 years. Diana Olick is here now with the details.
Well, Kelly, it actually fell to the lowest level in 22 years last week as interest rates went on the upswing again. Demand now about half of what it was a year ago.
What does this mean for the homeowner, the buyer, and the seller? We've got a lot to discuss, and it's all coming up. Stay tuned. Hi, this is Warren Oberholser. As CNBC reporters just stated, mortgage applications are at record lows. What does this mean for the buyer, the homeowner who wants to refinance their home and get some cash out, and of course the seller? For buyers, the average contract interest rate for a 30-year fixed mortgage with conforming loan balance just increased to 5.4% from 5.33%. Application for mortgage to purchase a home fell 7% for this week and were 21% lower than the same week 1 year ago. Mortgage rates are back on the upswing. After a brief decline in May, and the housing market is still suffering from a lack of listings, as a result, mortgage demand continues to drop. Total mortgage application volume fell 6.5% last week compared to the previous week. What does this mean for homeowners? Refinance dropped 6% for the week and was down 75% year over year. The vast majority of mortgage holders now have rates considerably lower than the current ones, and even those who would like to pull out cash out of their homes are choosing second mortgages rather than refinancing their first liens. Okay, how is this affecting the sellers? As we know, real estate is hyperlocal, and housing inventory is still at record lows. Cities and areas that have strong buyer activity should be able to hold their value for now. But cities that have been overvalued in the last 2 years are at risk of price drops. Moody's listed their 25 most top overvalued cities and regions. Home prices in these areas could expect as much as a 5 to 10% drop in value. Here's what the chief economist from Moody's Analytics had to say on this.
I wonder if you can just kind of talk a little bit about, in your mind, what happened to make Boise so overvalued?
Couple things. One is the previously low mortgage rates. During the pandemic, the Federal Reserve slashed interest rates to try to get the economy going. And of course, that juiced up housing demand because it just looked really quite affordable. But there wasn't a whole lot of supply, very limited supply. So you raise demand, not enough supply, and prices rise. The other factor is remote work. During the pandemic, a lot of people left the big cities on the West Coast, Seattle or San Francisco Bay Area. Those folks are used to really high house prices. So they come into a community like Boise and they say, oh my goodness, this looks really, pretty cheap. Even though they're up 30% from where they were a year ago or 50% where they were 2 years ago, it still looks cheap for someone from the Bay Area of California or Seattle. And so they've juiced up prices as well. So both those dynamics have played a key role in causing house prices go skyward in Boise. Of course, interest rates are up and remote work is starting to unwind. So those supports to house prices are starting to fade away.
However, according to CoreLogic, house prices in some areas are still rising.
Prices are still rising. A new report from CoreLogic this week showed prices still gaining in April, up close to 21% nationally from a year ago. That's because while there is some new supply coming onto the market and homes are sitting slightly longer, supply is still historically low. Large cities in the South, especially Florida, seeing both the hottest prices and the lowest supply. And unfortunately, the home builders haven't been helping much with housing starts falling in April.
Going back to real estate is hyperlocal. Each area will not react or respond the same way as mortgage interest rates rise. Clearly, they're all being affected by this, some more than others. Real estate is quite different than other markets like the stock market. It takes like a 6-month lag period to really evaluate the effect of some change. So when we had the pandemic, it took probably until the end of that year in 2020 to see how much prices went up. So when mortgage rates went up from, it started in February, I think, that's when we started to see changes across the board. We first saw values, home purchases go, 15-20% over the list price. And then once mortgage rates cleared 5% and went to 5.5%, that's when we started to see buyers dropping out, values still holding, but we were seeing, more hang time on the market. Now, in some areas, we actually saw price drops quite quickly. So each area will be different. We'll have to see how this year plays out what will be the effect of all of this. Please let me know your thoughts on this, and especially what has happened in your area as mortgage interest rates went up so fast. If you like this video, please give me a thumbs up, post your questions and comments down below, and if you haven't subscribed to my channel, consider doing so you don't miss anything. If you found this video interesting, you may want to check these other two out because I'll go into more detail on what I just talked about. So stay tuned. I have more helpful videos like this coming soon. Please reach out to me for any of your real estate questions or needs, and I wish you all the best on your home journey.